Good morning, everyone. Welcome to the Euro stream. It is bank holiday in the US, so the markets are expected to be lower liquidity. And we can already see some weirdness happening in silver. If you're new here, welcome. I'm Marcus D. I'm your host. I've been trading for 19 years and I'm a commodities trader, which means I focus more on base metals, precious metals, and energies metals as well. Now, a couple of things that I don't like here when I see, first of all, this big spike that happened right at Globex Open, established Asia high and low, and we've pretty much been range bound ever since. When I look at the options chain, I can see there are many levels with weaker positioning, so very low open interest, with some bigger areas way outside of this range, but notice how close together all of these levels are. We have 1, 2, 3, and then a bit of a space, 1, 2, 3. Whenever I see that, that is technically dangerous market conditions. That makes it a very difficult read, and not unusual for bank holidays, so it is entirely expected. So even if things move today, it's going to be tricky to figure out which side and whether they're going to be range bound, because sometimes they're not range bound. Sometimes you have these moves that just kind of carry on in the same direction on holidays, but they don't really have much volume behind them. So that makes them a bit dangerous. Why? Because we're in danger of having a wick like this. See that? That's not normal, right? It's not normal. Unsurprisingly, the implied volatility has fallen from Friday. So we're sitting at minus 9% of volatility decrease from Friday. And Friday was pretty range bound on silver in particular. Now looking at copper looks a little bit better, so slightly less crazy. But again, there are things that are spelling holiday day. First of all, put call premiums are almost 50-50, like balanced when it comes to the pricing. Again, Asia range not very big compared to what we had recently, but it looks a little more sane. However, VWAP is very flat. Price action has been pretty slow. And some of the more significant levels are sitting at 590, and then actually lower down at 560. There's not that much of interest in between. There are smaller areas, so there's one at 575 and one at 580, but that's kind of the Asia range, so you don't need to put a separate marker in there. The average ranges on holiday days are not expected to be reached. Why? Because it's a statistical outlier. So just like we can have a huge trending day, we can also have a super quiet day. So nothing is really calling me to trade today. And energies are in rollover. The only one that's actually rolled properly is gasoline futures RBOB. Maybe there's something there, but again, if I do decide to do anything in RBOB, it's going to have to be closer to the shortened holiday hours, so in and around sort of maybe 4 p.m. my time. I am GMT time zone. I'm in England. The rest of them are literally a day from when they should be changing contracts. Crude oil. Nat gas. Let's see if heating oil has rolled, because that's heavily connected. So even heating oil hasn't rolled. So the only one that's rolled is gasoline futures. And then I looked at the options chain. There's honestly nothing there. It's like all in. It's just super thin. Super thin. So be careful today if you do plan to trade. This is not the day to go doing like 50 trades because it's a holiday in the US, right? Now, if we were trading Eurex products, I would say there's, you know, maybe some opportunities in DAX or something, but we do not have DAX on Topstep, and therefore we cannot trade it here. But if you've, you know, if you got an option to trade it elsewhere, there are a couple of prop firms out there that do allow it. But it's a finicky connection because you have to go through like trader rates and then pay for an extra $24 for Eurex data, and then you can trade it. So it is possible, but it's a bit of a workaround across the board. All right, how's everybody doing? Let's see who's in chat. We have Amanda, we have Ani, Brishti, Trade with World, Cactus Leo, Ahmed, Raphael. It was all a dream, 66. I like that. Are all those green candles or silver bots trading? It's probably a zombie rally because of the low liquidity. That's sometimes what happens in low liquidity environment. There's a famous saying in the trading community, don't short a quiet market. And that kind of goes across the board. You know, I've seen DAX go for like, you know, 400 ticks, all in like smallish ranges, but just keeps pushing. It keeps pushing. And almost always those days were happening on some kind of a holiday day, right? So that's something to take note of. But yeah, I wouldn't be actively looking to trade today. There are better things to do than watching paint dry or being stuck in a zombie rally that takes absolute hours to reach the next destination. And also we're on silver in particular, we're coming into an area where again we have these little options speed bumps. That's not a great sign because you get these spiky candles. So here's the problem with zombie rallies. It's not that it's like, oh yeah, it's directionless, or, you know, holiday days, not zombie rallies, but holiday days that go into a directional move. You get these super spiky candles, right? So in hindsight, without you kind of being a little bit more critical about what sort of price action you have, it looks great. It's like, oh, beautiful, it went up. But then you actually analyze what happened, right? So how big is this spike? This is a 100 tick spike on a 200 tick candle. Mind you, micro silver, which is the only thing we can trade here, with some kind of sensible positioning, and even that is a bit up for discussion. Do you really want to sit through a spike that's like 100 ticks? That's $500 risk. And then if I focus on this particular wiki, lovely thing, that's again 146. Are you really going to sit through that? Because I would. I know that I can do that, but I would need to be having my entry somewhere down here. And then I'm okay with that, but I know that many people are not. So what happens is that you had a perfectly good trade that you maybe caught earlier, and then you start seeing these spikes, and then you exit. So now you are thinking of re-entering. But now that entry is absolutely terrible. You're coming into the swing high, over to the left. We always look to the left, right? Coming into swing high. Coming into this chop from Friday, I mean, this looks absolutely horrendous. I don't like to trade those. I want to trade when the market has a clear direction. So this would be a clearer direction. This would be a clear direction. This would be a clear direction. This, complete mess. Think, you know, drunken girl coming back from the bar and just kind of going, bumping bumping along the walls in the alleyway, right? Unable to keep the straight line going. How's that for a depiction of price action? So yeah, to me, across the board in my products, it's not looking that great. I never want to see options levels with slightly higher open interest that are that close together, because that's not going to be smooth. You know, even if they continue higher, So you have this area here. So the only slight tiny opportunity that I see is between 77 and 76. Don't know why this is at a random level. But then this is also unusual. Usually you have the strike prices at round numbers, those with higher open interest, right? But this one is a slightly higher open interest, but it's at a weird level, 75,750. Like, what is that? And that is usually just a sign of lower liquidity, not many participants. Most of the major players are likely not going to be trading today. And yeah, you know, maybe it is the bots, could be the bots, but even bots need to be monitored. Like, there's this big misconception with algorithmic trading, how, oh, you just switch it on and you let it do whatever. Somebody's always there to watch it, right? You can't just let a bot do whatever, because bots malfunction, right? They get bugs, something happens, and you know, if you're not there to manage that, it can turn very ugly. So there will always be, you know, at least a clerk or a, you know, quant strategist in maybe some smaller companies to switch it on and off, and to make sure that they can intervene if something odd happens, whether it's the market or the bot itself. It's up for debate and a situation, but you know, you can't just let it run and go, oh well, yeah, we'll just leave the office and we'll leave the bots running. You know, those people are, especially on the institutional level, they're paid a lot of cash to you know, make sure that nothing goes wrong. And in my opinion, it would be a bit irresponsible for them to just go home and there's nobody there to oversee the bots. They're not, you know, they're stable, but they're not faultless by any means. So yeah. Where do I get my options infos from? Well, I mean, you have Mental Q if you don't want to do like any data crunching yourself, and that is certainly a great starting point. They weigh the GEX levels by the size of open interest. I go a step further. I look at Greeks, and I actually drag them directly from one of the APIs, and then I have some algorithms that crunch both the open interest and implied volatility per strike, and I have a couple of other things that I measure, and then I determine which ones are more interesting. So I give the weight to certain levels over the others, if that makes sense. So I wouldn't be taking any level just because we're coming into it. Otherwise, then you'll have something at every strike level, especially in more thicker markets. But you know, Mental Q is a great way to start. I do like to do my levels once at London, and then once as I get closer to the exchange open that I'm trading, so COMEX, NYMEX, sometimes New York Stock Exchange, but I'm not really an equities trader, certainly not New York Stock Exchange. And then I basically just finish it up for the day and use those levels to rely on them throughout the day. Mental Q does end of day levels, which is like yesterday's evening levels. And in commodities, I will say that on most days there would be not much change. The only time that might not be true is if it goes into some mad trending day, and then we kind of move very far away from the end of day levels. And for the commodities, I don't think there is a service that does intraday levels. So that was kind of bothering me, especially when we started to have huge volatility. So I defaulted back to my ways of doing it. But I do, you know, I do have a software development company, and that is my favorite pastime, sitting here and coding stuff. Either that or video games. Or walking dogs, of course. Because I've got 8. Anderson says, I use Mentor Q, pretty happy with it. Exactly. Yeah. So you know how they name the GEX levels? GEX 2, GEX 3, GEX 1, Gamma Wool, you know, all of that good stuff. HVL. those are basically your higher interest, higher open interest levels. So any GEX level that is like 5, 6, 7, 8, 9, 10, those are smaller open interest GEX levels. So therefore, they're more likely to be weaker and therefore to break and not to give a meaningful hedge from it. So it's a, very, very similar stuff, but the way they do it, they just weigh it in, end of day terms, whereas I like to have a look at it at the beginning of the day. So, and I'm a nerd, so there is that. D, can you please show us gold? Okay, gold has been on my naughty list. So similar to silver, we have a bit of a zombie rally going. But one thing that's still worrying me about gold is this dome. I mean, look at that. I wouldn't trade this. This is a spread of 1, 2, 3, 4, 5, 6 ticks. Since when do we have a spread in futures of 6 ticks? And why do we have a spread in futures of that amount? Is because the liquidity is just not there. Now, arguably maybe MGC might look a little bit better, but it's still gappy, okay? Gappy with a daily ADR, average daily range of 1,700 ticks. That's a lot of market risk, right? And also look at the candles, very wicky, right? There's no smoothness there. There's zombie rally, but the volume, if you have a look at the volume, is way below. Like, look at how low that is. It's horrible, right? It's way below the average of the low average already. So it's not just below this average from like COMEX, this one here, but it's also below the average of a quieter Asia session. So some caution definitely on the cards today. We don't have to trade every day, and this is the day, it's President's Day in the US, and you should be doing something else, not staring at the charts. Even I, with all of my involvement in trading, I try not to spend more than about 4 hours per day trading, because I get tired. Everybody gets tired. My mental capital just goes straight out the window after 4 hours. So if I have to work more because of my the nature of all of my jobs, it's all trading related. I don't really do anything else. I used to do IT recruitment and used to have a company, but these days everything I do is heavily trading related, right? So that means that if I need to look at the charts and make decisions based on it, I need to have a little bit of a brain reset, which is either yoga nidra or a nap or something, just to kind of wipe your brain from whatever it was doing before, and then to try and come back with fresh eyes. If you continue to trade for 5, 6, 7, 8 hours, 12 hours, you don't get paid for your time. We're not here to get paid for our time. We're here to get paid on being correct, on the direction, at the right time of day, and at the right setup. A high probability setup. So I would like you to put outside of your head this idea of time versus money, which is so ingrained in everybody these days. And, work harder, get more money. That doesn't work in trading. I wish it did. I really do, but it doesn't. Because, I'm a hard worker. I was a session musician before I even went into finance. That requires you to practice 10, 12 hours a day when you're leveling up your skills. And that's fine. But in trading, hard work should be more studying in your journals, and maybe some back tests just to get at least an idea of the mechanistic nature of a playbook. And then from there on out, it's like sit there when it's the time of day for the setup, and probabilistically when that setup can actually happen, see what happens, note it down in the journal, and move on, do something else. But don't do active trading for like 8 to 10 hours. That's crazy stuff. Even when I worked in a prop office, worked in a prop shop, if you made money on the day, they would kick you out. They would be like, yeah, all right, go home now. And you'd be like, what? So, to me, I never worked in an office before that, and I was like, what do you mean go home? Like I'm here. They're like, well, yeah, but you made your money. It's like, go do gym or something. I don't know. And I'm like, so you don't want me here? It's like, well, no, not if you're gonna give it back, because you keep trading outside of your times when the setups occur. I'm like, okay, it's cool. So even in prop firms, in office prop firms, that that was very normal. No, it's, you don't get paid for time. So I mean, look, Ani, you're right. Most jobs require to put in the hours. Trading is a very fine line. You have to put in the hours studying, absolutely. Studying the concepts, maybe watching some lectures, or watching videos that are explaining a concept, reading books about it, reading profile, reading technical books, reading psychology books. Yes, we need to put in the hours to do that. But what I see people doing is just like sitting at the charts, not studying, and just clicking buttons, running up combines into the ground, or XFAs, even worse, and then going, oh, this is a scam. It's like, okay. So how about you first learn about the, swing highs, swing low, Asia high, Asia low. What are the Shanghai hours? Like, who trades metals here? I trade metals. Can you tell me in your time zone Shanghai hours off the top of the head without Googling it? Can you tell me Tokyo hours? Because that's one of the major exchanges. Can you tell me COMEX hours, for that matter? Things like that, right? When does this exchange open? When does it close? Why does it matter? How does the price action behave at that point? That's the studying that you're supposed to be doing, not this, sitting down and clicking buttons and then, 20 trades deep and you're like, you've dug a hole for yourself on the first day of XFA so deep that it's now going to take you forever to get out of it, or you're going to blow it. It's like, you don't want to be in that situation. And I was on Aaron's stream, just kind of lurking in the background while I was getting ready. And someone asked Aaron whether a $280 day is going to ruin his day. And he was like, what? It's like, that's like scratch. It's a scratch day, right? And no loss, when controlled, should ruin anything for you. And if you're still emotional about losses, you need to adjust your expectations to look at your performance, not in per trade, but per week, per month, per 3 months, and per 6 months performance. Then you will realize that a controlled loss of one single trade, that's like, it's nothing, right? Until you get over that, and until you're like totally emotionless, losing $200-300, hey, even losing a controlled loss of $1,000, $2,000, $5,000 a day, if it's within your risk limit and the account balance size, because let's put it into perspective. If you have an account balance of 1 million, losing a couple of grand, it's not much, right? It's nothing. Okay? It's nothing. It's within. I know it sounds horrible. It's like, oh my God, you've just spent. But this is why you have to, as a trader, move away from the P&L side of things. Because you will get to a point where, you might be, like I was trading pretty big sizes at one point when I was like younger and still, pushing the whole prop game. I was trading like 100, 120 contracts per trade. That's an insane amount of risk, right? And you're thinking, oh my God, it's a down payment for a car, or that is a car, But you can't let that get to you, because it's like, it's all about ticks. So when you convert this to points or ticks, every trade becomes the same. It's like, okay, well, I'm in with 80 lots here, but I'm in with like 2 micros on this one. Why? Because of the account balance. And I see questions constantly say, oh, well, if they're such good traders, why are they in combines? Because a lot of us practice and why do we trade with such small size? Because you start with 4.5K. Okay, you can't trade with the same size that I trade in my, massive account when I only have $4,500 to risk. So you have to scale it. Everything needs to be scalable, right? And to me, I see those comments and I go, amateur. So, But the prop industry is weird these days. We seem to have trained people to start off on 4.5K and plow in a 3 mini NQ or 3 full micros or 3 full silvers, and then YOLO it, get lucky and go, oh yeah, look at me, I'm really great. It's like, yeah, you just gambled your way to your thing. And that's why we're in this situation where a lot of the prop firms have now restricted metals. Is that what you wanted? Well, congratulations, you got it. Now, luckily with Topstep, we can still trade them, but at a restricted level, right? And but yeah, just do remember that some of the trading practices that we see today, those are not professionals, right? Professionals are, I worked with somebody called Rick Casilli, you may know him from YouTube, and, Rod Casilli, Jesus, it's still early, sorry. So, he always preaches micros, and he's been in the industry forever, right? He is one of the, he used to be a broker, and he is, a guy that knows a lot and has a very different style to me, but we both always preached smaller size. Why? Because once you have some account balance, it's easy to add an additional micro, or 2, or 3, or 5, or 10 as you scale the account, but not to start with some crazy positioning. And then people are, coming and going, oh, this is impossible. Yeah, it's impossible the way you're doing it, for sure. But, just try to remember that when you're starting a new XFA, you're starting anything new, it's not forever, the smaller positioning. It's not forever. It's a means to an end. It's a stepping stone to larger positioning someday. But at the same time, it's a beautiful opportunity to start generating some side income when done correctly. But without consistency, there is no longevity, and all you're doing is just clicking buttons and not learning. So use your time to learn about the product that you're trading. By all means, spend time backtesting. I'm not really in favor of too much backtesting, because the backtests are good to test the mechanics of a trade. But it's not going to teach you anything about the real-time market. It's not going to teach you how you behave when things don't go to plan. And when you start getting that, that dichotomy of the market doing something you didn't expect and your brain was aiming for something else, you have to learn how to deal with that, because that is an inner conflict depending on the outer world developments, right? So you're like, you want to go short, but then the market goes long. And that, in a lot of people, triggers a survival instinct fight or flight response, right? And you have to get over that. That is the prime name of the game. We don't have the pits anymore. We don't have, Merrill Lynch over there, Goldman guys over there. You can't see what they're doing. So everything is very much internalized and very, very much kind of you versus you sort of moment these days. And that's changed. Before you didn't need all of that, but now you need inner peace. you need to meditate, go to the gym, take care of yourself, make sure your brain works, because the only piece of information that we have is in the order flow and the charts. That is it. How are the dogs doing? Oh, Short Life Hacks is here. Hello. Short Life Hacks, one of the institutional market makers. You can ask him all sorts of questions. He is not able to come on Topstep TV because of his job. But one of the true people who are true scalpers and has algos to do it as well. So, haven't seen you here in a while, in a hot minute. What session time do I use for market profile when trading DAX? What do I consider RTH? I consider RTH London Open. I know that it's technically Eurex, but Eurex is a small exchange. It doesn't really have much volume to it. So whatever Eurex does, London can do better. And London comes in with a massive amount of volume. So I use for the profile in GMT, convert that into your time zone, 8 a.m. until 2:30 p.m. GMT. Why? Because 2:30 is when you have the New York Stock Exchange. Different players, different volume. Don't like mixing apples and oranges in that way in profiles. And we tried it both ways. We tried to see whether the edges of the value areas will be better if we smushed the final sort of 2.5 hours or 2 hours of the Eurex and London trading. Didn't work well. Why? Because the New York volume was too much. But the value areas that we cut off at the New York start, they are very, very, very accurate for both open sentiment but also trade location on DAX. I would also argue on other products, but let's not get into that right now. Is Europe high volume when USA is on holiday? No, Europe doesn't care much what USA does, frankly. We have our exchanges and they keep trading. You know, they trade whatever they're going to trade, but they're not going to trade, you know, ES and NQ. They will trade DAX, right? So we can have a look at that. We're not going to spend too much time on it, but you will see. The DAX looks like it's having a perfectly normal day. It's doing what it's always doing. So it's just, I haven't done the levels here yet because, again, I don't know how much I'm gonna trade today. But here's the value area from London. And that's the edge. And yeah, so far we've moved 95 ticks. It's within perfectly good size. Considering we are currently working with 266 London average session range. And yeah, it doesn't look like a holiday there. Candles are of decent size, volume is up. But yeah, why would you think that they would trade more? Like they are just an exchange, you know, they don't make their decisions on whether the US is trading or not. They have Eurex and they will be trading on Eurex with volume that they normally trade. So no, that doesn't have any bearing. But for the products that have an overlap with RTH being the major exchange in New York hours, I would argue that those products will be different, right? So things like crude oil, for example. Like today is a weird day because we're rolling, but normally crude oil is going to be less active for the regular trading hours, but London may comparatively look like it was trading a lot. But look at the volume, it's still low, right? It's still the same amount of volume that London does. However, the thing that might change is that as we get into the NYMEX hours, it's going to be a little bit trickier to to get any moves that have real juice in it, especially on rollover time. So yeah, so it depends on what you're trading. If you're trading Eurex and London specific products like FTSE 100, like DAX, Bund, they don't really look at what the US is doing really, but you know, they keep trading whilst they're trading. It's just the difference will be because of the holiday hours and the shortened hours, those products that maybe move after hours, they will just die a death earlier. So, you know, it's going to be maybe silver, you know, that still does a lot of volume after the London close, even into the lunch hour. It used to be like very quiet. Now that doesn't seem to be a thing anymore, or at least not for the time being. But it, you know, it will probably die out already as soon as London closes, and that'll be it, because we have shortened hours and technically you can still trade until 6 p.m. my time, but you know, the volume is just going to be a bit weird. And you need volume to move the markets, you know. You need volume. Don't expect the statistical ranges to play out today much, because we have, again, a slow day. So, you know, plotting the ADRs and ASRs when the ranges are like a third of that. Just to give you an idea, so normally for London, we see silver moving 792 ticks, and this is across the last 10 days average. At the moment, we have only moved 164 ticks. So not even a third, right? It's very quiet. Hi D, can you look at NG, give your perspective. And Natty is also rolling, mate, so I wouldn't be buying anything. And natural gas, if you get stuck in the rollover, because of also the early close today, you may get a notice from a warehouse that they are about to deliver some natural gas on your front lawn. Not your front lawn, it happens in warehouses, but you will get notice of delivery. First notice. So yeah, be careful trading actual commodities with physical delivery around this time of the year. And yeah, I would just wait until this rolls, because this is the previous contract. Natural gas expiry should be happening by tomorrow, I suppose. Let me just double check that for the exact date. Yeah, so in and around the 17th is where it normally when it rolls. Just looking at the CME side. Yeah, so still hasn't rolled. It's still on March contract. And April is trading with 10,000 contracts. We're still trading with 20,000. So it's rolling. So I wouldn't be messing with Natgas today. And I know that these gaps look great, but then look what happens after the gap. So is it like super lively or not? Look at it, gap, and then nothing. Do you think this is a great trade? It's quiet, you know. And if we go the previous week, we had another gap. Arguably this was a better one, right? Better opportunities. But then again, natural gas always does these gaps. Here's another one, gap up. What does it do for the rest of the several hours after? Nothing, right? So natural gas has to be timed a little bit more carefully. And when it's moving, you will see it, right? There will be volume behind it. There will be these pops on one side that are super quick, and then they don't really get a pullback. So that's the natural gas thing. And it really speaks to either increased supply or increased demand. So it can work both ways. And it's a very stable directional product when it's moving. The trouble is when it's not moving, it wags around. As one of my I have a coach that I hire to help me out with my stuff. He's an Australian guy, and we're all adults here, right? So he goes, price action is moving up and down like the horse drawer, which I think is very apt, especially for RBOB and arguably gold these days as well, and Q as well, you know. Can you see the euro dropping below 117? I don't trade Forex, and honestly I'm not really interested in Forex. It bears no relevance to what I'm doing here, because I'm looking for, like, even I with my, 70 to 100 minute hold time, it's not a long enough time frame for any sort of bigger fundamental relationships to play out, because the fundamentals play out over long periods of time, and intraday you can have a whole bunch of shenanigans happening outside of that, with the spread difference between correlated products, like let's say gold and silver, for example, And there are whole strategies that like play on that. So, you have the gold-silver ratio, then you have the crack spread that takes in crude oil, RBOB, gasoline futures, and heating oil in a very particular ratio. But, that's all like technicals that they get outside of each other. So our job really is not to look at everything that Bloomberg tells you to look at. It's to figure out whether something has gone too far in the day, or whether maybe we are establishing a new trend for this particular time of day. But then you get to the end of the day, or some kind of exchange settlement, and you get the enforced hedging into settlement. Is that a macro side? No. And that's the kind of trades that made my career, frankly. Enforced hedging into settlement. Fade the settlement into and after, because that varies throughout the year. Sometimes it happens half an hour into it, sometimes it's right after. So obviously you have to be good at reading price action. But yeah, I don't like to trade nat gas or any energies in rollover because it's a pain, it's annoying, and it's watching paint dry. So I would rather stick pins in my eyes, to be perfectly honest. Yeah, Verti, you're right. And QX like a little biche. That's right. I'm shorting the euro because of the yen. Yeah, you see, you look at currencies. I have no idea what yen has been doing. Nor do I care these days. Again, commodities trader over here. I love commodities. I traded Forex when it was the heyday of Forex, right, in 2007 all the way to 2012. I was a swing trader. It was beautiful. But then it dried up, and then we had the credit crunch, and then we had European austerity measures, and they ruined the carry trade and everything around it. Carry trade disappeared. Every so often it pops up its head. And why is the carry trade important? It's because it tells you that the institutions are doing the positioning that is taking in the difference between the country's interest rate differential. It's a mouthful, say that 10 times fastly. So you need the interest rate difference between the two countries to move the carry trade, right? If you don't have it, and everybody was on like 0.25 basis points, 0.5, minus 0. Some countries were negative, Japan and Switzerland during the credit crunch crisis and post aftermath of everything. And that was like the first sort of 6-7 years, right? So I started in 2008. We had the credit crunch. 2007. Credit crunch was 2008. Although to be fair, I was already looking at stuff in 2006. So it was like, but I didn't think I could do it until I met a friend who was a trader, and he explained to me what it actually was, and that I should really try it, and he reckons I would be good at it. And here we are, almost 20 years later, right? But yeah, I traded Forex extensively, and I had I actually had a co-integration algorithm that took in countries with then still higher interest rates, which was Australia and New Zealand dollar. We also had the Mexican peso in the mix, but it was very volatile though. And then we were using the major pairs, so pairing it up with the exotic ones, and then in the futures we were actually making the synthetic currencies from both of those, and it was so expensive. Oh my god, like Aussie dollar and New Zealand dollar are pretty unusual. Well, they were pretty unusual for the futures at that time. Again, this was a long time ago. It was a very different time. Credit D over here. So, yeah. Trader CJ says, yeah, don't do it. It can go lower. Do it. The whole it can't go lower and will fill the gap trade always gets me. Yeah, so Natty doesn't really fill the gap trades. This is where you have to be familiar with the behaviors. You know that studying that I was telling you? Instead of clicking buttons and starting a new combine, you basically see how the gaps behave. And for example, how long it takes to fill the gap, if at all. Because, you know, somebody asked me this question, actually, I think it was like 2-3 weeks ago in group coaching. They said, do you think, do you think that the natural gas gap is going to get a fill? And I was like, well, probably not, but how do we define a gap fill? If we left the gap now, and we fill it in February next year, is that a gap fill? Sure, it filled the gap from February last year. It's, you know, it's context matters. This is why we say, so I presume when people say, oh, will it fill the gap? They want it to fill it either today or this week, correct? Nat gas doesn't do that very often. Sometimes it does, but it's just not a statistically relevant enough of a event for you to base your strategy on it. So you need something else. And the gaps in weekend gaps in Natty are very normal. Like it is what natural gas does, right? It's the widowmaker for a reason. That is the reason. So you know this is very painful. Let's remove VWAP for a second here just to see how horrendous that looks. And in any other product, equities, gold, silver, gaps do get a fill within a week, right? Not in natural gas. Why? Because it decides that it's a supply and demand issue. So if they have enough storage, they're like, you know what? We don't need actually to have natural gas this high up. Let's bring it back down to 3 evens, shall we? Now 3 evens has been an area of interest for me. So not because of the gap, but 3 evens, but it's the wrong time of the month. Not because of me, but because but because of the rollover, right? So we're rolling into the new contract. Anything can happen. They can just gotta keep going, and then they can bounce from 3 evens in the new contract, which might be, you know, higher up or lower down. I don't know. I haven't actually looked at the price. Actually, it's a bit lower. Yeah. So it's 291 when I looked at it versus 299 in March versus April, or April versus March. So yeah, they still might reclaim 3 evens and go higher, but I want that to happen in the April contract, not this one. But you know, one of your studies and how you should be approaching this should be thesis. How often does natural gas fill weekend gaps within a week? And then you can go down. How often does natural gas not fill weekend gaps? So should we trade, with the gap and continue to move away from it? What is the distance that it carries on trading after the gap before it bounces? Is there something there? Is there a pattern there? Maybe you find that there is a percentage-based, moment where you find, well, this one was minus 6.5% from the gap. Right? This is how I look at the markets. This is why I'm the nerd, the ultimate nerd. And then this one, okay, we have a very big gap, well, a reasonably big gap. And how much do we move away from the gap before we continue in the opposite direction? Well, this one is 3%, so nothing there. But you get enough of a sample size whenever there's a weekend gap, and you might actually come up with some sort of a median average. Not the mean, because the mean takes in the spikes, the outlier spikes, that they're too much. But the median, where it smooths things out, you might get something. And then, you do this. You don't need an algorithm for this. Here is went to the upside. And we filled that. Why? Because it was just that time of the year, right? So reasonably sized gap. How much did it move before they started pinging it back? Well, pretty much immediately. But what was the percentage of that move? 4.9%. Okay. So now we have 6, 3, 5. And then you go back like that 50 times whenever there was a gap. And you call your thesis, how much do we move after the gap? It's the same thing here. You grab this one. How much does it move before it stops? It doesn't. Why? Because we got cold weather in January. So this is your macro side where the outlier steps in and the seasonality comes into natural gas. And then whatever you are looking at is out the window. Why? Because it's seasonality. And then you have to default back to the seasonality reports and whether we have storage or not and how cold is it compared to the previous 10-year average. And that's how you make decisions. And after all that is done, you can then look at the technicals for zoomed in picture, but you have to understand, at least with natural gas, what is driving it at this time of the year. Some of the other parts of the year, you don't have to do that because it is very technical. But when you have cold weather and seasonality kicking in, you can't just ignore that on Natty. You just can't. So. Again, doesn't the gap get filled always? No, not in commodities, because commodities are driven by the actual physical supply and demand. Let me guess, you're an equities trader. Yeah? In equities, gaps usually get filled. Why? Because they're mostly technical, because those products are cash settled, right? There's no physical delivery. Nobody's going to deliver you, 1,000 contracts of S&P on your doorstep, like knock on the door. Hello, good morning. 1,000 S&P contracts. It's like, what is this? Oh, I forgot to close the long in the S. Okay, you're not gonna get that, right? It's cash settled. There is no physical delivery, but the commodities, there is an actual physical delivery on the minis and even the micros. But the new contracts in metals, so the 100-ounce silver and 1-ounce gold, they are cash settled because they are made for speculators. So they were made to be to make the metals that have gone insane more accessible due to the margin requirements. So CME is still like, give us your money. Yes, when we will give you this little tiny contract that you can trade, okay? But you get no gold or silver or copper in return. Is that right? So it's you have to know the intention of the product. You have to know why it was created. That's like the basics. Again, that's studying, knowing things about your contracts and the products you're trading a little bit. But at the same time, don't go down the rabbit hole of silver mining and yet you hold your trades for 2 minutes. That serves no purpose. Just know when the exchanges are opening, know whether there is any problems with supply or demand with silver and why that might be. Find out about paper COMEX contracts versus the actual contracts that are traded in London and Shanghai. So maybe that's useful, just to understand why things have happened the way they have, because everybody's blaming margins. I blame the paper contracts because they have artificially been pegging the silver prices for years. Silver used to be like crude oil, just pinging in a weekly range from up and down, and like ping pong, playing ping pong, boing, 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 boing. And then suddenly, that started breaking down. The demand for silver started rising. Why? Because of AI and the EVs as well. Electric vehicles use a lot of silver because they also use computers. And guess what? It's all copper and silver. And silver in particular, we are in a mining deficit from the output. So that caused the initial run up. And then everything that's happened since, it's a mix of margin problems, so hiked up margins by the exchanges, but then also the fact that the paper contracts were so far outside of the pricing that it had to break. It had to break. Something had to happen. And then it broke to the upside. We hit 120. And now we found a pretty middle ground at 77, which is a good base for anything to happen in the future, right? Now, I still have some of my silver bars from when this was at like 45. And then I bought another one at 71.50, I think, 71.53 the second price was. I think that's a good base for the next sort of 10, 15, 20 years. I don't plan to sell them now. And they're vaulted, right? They are not pennies under a mattress. They are in a vault. So therefore, whatever happens, I am prepared. Can even go Mad Max style now. Natty is better during the winter times. It's pretty good during the summer times too, because you get natural gas is used in air conditioning. So if you get really hot summers, Natty sees an increase in demand. But again, there's a little bit of an interplay between how much storage they have versus how much demand there is. So yeah. I only trade gold. Yeah, gold is very speculative these days. Gold is not necessarily only used by producers and users, and it's gotten very speculative. Why? Because everybody's turned into a gold trader ever since it started breaking some records and went to, well, at first, let's have a look at the very large time frames. Let's have a look at the monthly. Oh yes. Huge. So 2021, we don't really have data before then, but it's fine. Where were we? Well, we were kind of 2000, right? Even that was pretty high. I remember when gold was still like 1200, 800. And then, you know, post-COVID, we had, 2 years later, a little bit of a dip, and then it turned. On this contract, this is 1932 pricing, 1932. And then it started breaking out. But in and around COVID, a lot of gold traders started coming up. And all of a sudden, I think about 2-3 years ago, I noticed that gold has become, like price action wise, a lot more chaotic. Because if you go and compare, I've been trading gold since 2012, so basically the same amount of time as trading crude oil. So I never saw it this spiky, right? These spikes, that is the introduction of the smaller speculators that are adding noise into price action. And, they never really win because usually the institutions are the ones who hold the power. Why? Because they have the cash flow and the size. And until the only place where that's a little bit sketchy at the moment is the equities, because we've currently had, especially in the ETFs, we actually have retail that has gone in volume over the institutional volume. So at the moment, like last time I looked at it, I think it was in SPX or something, it was like 60% of volume came from retail. That's a little worrying, frankly, because what are we doing, It's good that retail has stepped in, but we cannot have people who don't really know what they're doing controlling a good share. And that's also the reason why I dislike trading equities these days. Because I don't feel like they are stable enough, and there's a lot of irrational movement there that doesn't seem to be driven by anything. So I don't like that. I like to have a regulated, structured reason, same reason why I don't trade Bitcoin, because there are no structured events throughout the day that will bring higher probabilities at a particular time of day. It's all very chaotic and just random. When it moves, how it moves, like you crunch like, quite a few years of Bitcoin and you don't really see a proper pattern of price movement. There is some isolated times when it goes hand in hand correlating with ES, and they look like twinsies, but it doesn't last too long. So obviously there's something that happens in the monetary policy, and then they are moving together, and then they stop, and it's certainly frustrating. I look for structure. I look for, things like post and workout option expiry to happen, silver pricing midday every day done by the LBMA. You have Shanghai pricing also. So there's things that happen all the time that are based in the benchmarks throughout the day, and I like to base my strategies around those. So sue me. Based on my expertise, do I think gold is due for a severe pullback, 20% or heavier? I don't know. I don't look at the market that way, and this is the huge release and power. I'm not thinking, do we have 20% pullback on the cards? I just look at what is here and right now. I don't speculate like that. I'm not a fortune teller. I don't have a crystal ball. All I can tell you right now is that on the daily chart, we have consolidated. And let's have a look at the weekly chart, because sometimes you get some clues that are not always obvious on a tiny chart. I mean, wasn't this a pullback already? This was a 13% pullback, and from the top, this was a 21% pullback. So I would argue we already had that happen, surely. Wouldn't you say that? Did we pull back already 21% from the high? We measured it, yeah? 21.44% to be exact from the high. But do I think that we're gonna have that now? I don't think so. We are just sideways. And we've been sideways. This looks like we're finally kind of settling down from the ridiculousness of the margins and the carnage that we've seen and volatility that we've seen, and we're coming back into some more normal price action, if you can call it normal. But it's not normal yet. Nothing that moves 1,700 ticks and is a commodity is normal. Nothing about that is normal. So really I need to wait until we're at least kind of going 600 ticks per day, and that becomes the new sort of range. Then I might have a better read. But right now, this is a hangover after the whole volatility fiasco that we've seen. Did we hit 5,625 or 630? Yes. Did I see this happening? I could see signs, yeah. But how? Opens below value, inability to go back into value, profiles that are just not really extending to the upside, but in fact getting very quickly sold downwards. And then it just started snowballing from there. But me saying, I saw this was going to happen, I don't look at the market that way, I'm afraid. I just see what's in front of me right now. And, I say things like, gold, it's a holiday day today, so it's a bit of a crappy example, but still. Today, I can tell you that we have 2 days of overlapping values from Thursday and Friday, and right now the price is still inside the Friday's value from COMEX. I can tell you that with great certainty. Why? Because I can see it. I can also tell you that if that doesn't change, and if we don't make any headway either way today, that is going to lead to a bracketing market. Now, after a drop, a bracketing market is usually a signal for continuation. Why? Because after a drop, if you are a devotee of Wyckoff, which I've studied as well, I call that phase 1, accumulation. What follows phase 1, accumulation, 70% of the time? Markup. What is that? It's an uptrend. And it can happen in uptrends or downtrends as a general rule. Why? Because accumulation, markup, distribution, liquidation are the 4 phases that you can always find in price action. on any chart, right? So here, even though we're in an uptrend, here is a bit of the distribution, here's the liquidation, here's the markup, okay? But in a long time frame, if you go back to the weekly chart, this now could be also reaccumulation. Why? Because that's what the structure is telling us. Could it be distribution? Yes, but in that case, I don't think we would have ended with a huge wick. So context matters. That's how I look at the markets. I'm not thinking what's coming next. I'm thinking what's in front of me right now. Does that make sense? Because that's a huge difference, and I think that's where a lot of people go wrong. They try to predict what's going to happen, and I'm like, I do predict through probabilities and what's in front of me, but if I'm wrong at the same time, I don't go, oh, it should have happened. I'm like, okay, moving on. But the keeping it in the now mindset is what will keep me out of trouble on most times. So we're not predicting. We're here to crunch data, use context, and then go, this is the best guess, effectively. It is a guess at the end of the day. It's an educated guess, but it's not a prediction of any sort. It is taking in current price action and then seeing whether somebody, like for example, if we look at one of the options levels. Well, I could say that on silver, we have a weak call wall. So I would say, you know what? I think this is going to bounce further, because why would it, like, who is here to actively sell it today? And it could go down. But the fact that we have shown a little bit of strength above the weak call wall here, I will be looking at tape, at bookmap, to see whether there's buyers still engaging. Granted, I like doing that when the tape is fast and when we actually have volume. Otherwise, you're watching paint dry, however you want to spin it, and it gets very painful trying to sift through all of the noise, even on the tape. So it's easier when things are obviously more plentiful and we have volume and juice, the lifeblood of the price action, which is what? Liquidity. And then you can see the institutions stepping in, you can see the size of them, you can see their intentions a little bit better. But, you know, am I predicting this? I'm not. I'm just saying, well, we went above the 77, and because they didn't hedge there, my best guess, so to speak, depending on context and my experience, is that we will go a little bit higher. Do I think this is a good opportunity? Hell no. We're too high up. We're very close to the supply. So really, if I want to get involved, VWAP would be my only choice here. Maybe if we get down to 75, that would be a strong setup. Anything in between, it's like at best 50-50, maybe 60-40, maybe, right? So if you can find that asymmetric opportunity, that's a good thing. But, you know, just because you can read price action doesn't mean that you should be in on every trade, right? Because I can read price action. Like I said, most of the time I can tell you what they're trying to do here. But to me, this is too risky, you know. For the longs, yes. Smacking into supply. So what does that mean? It means that we're going to have a lot of consolidation, push, pull. Why? Because these guys stepped in. Somebody was interested in selling it here. So until I know that these guys are going away, there's nothing else for me to do. If you like toxic relationship, just come to gold. Yeah, I traded gold for a long time, and then I think when did I stop trading it? I think it was October last year. I was like, you know what? I think this needs to do whatever it's going to do, and I'm going to trade something else. So this is where I turned my attention to copper and to gold and to silver. And everybody was like, yeah, D, you with your weird products. Yeah, whatever. And now they're like, oh my god, yeah, silver. Everybody's trading silver and breaking down the proper industry from it. Like, I've been trading copper for years. I've been trading silver for years. But it was boring up until, like, literally, what was it, July last year? I could see something was up. So I brought it up and I said, listen, guys, there's something happening in silver. And nobody was interested. Nobody. We were, like, sitting here with, like, you know, people just rolling their eyes, going, yeah, RBOB, and what are all these products? And I'm like, okay, you've been warned. You've been warned. And then it all explodes. But just remember where you heard it first. That's all I'm gonna say. Is that prediction? No, it's just experience. It's like me looking at the chart and going, this is breaking out of a very, very long-term range. That is like, what is going on there? So I went digging, and then I found out the whole deficit in the mining, and then we're going to fall short of the amount that is necessary whilst the AI industry is like exploding and they're spending ridiculous amounts of cash whilst also needing silver to manufacture all the chips and the servers and data centers and all that. And I was like, oh, this is like something's going to happen here. But, you know, what do I know, right? Who cares? Yeah, I cheated on gold with copper and silver. That's right. Traders are the biggest creatures of the night, ladies of the night. I'm trying to keep it PG. I really am, but sometimes it's very difficult in the trading world. So we go where where the interest is, where the problems are, where, opportunity lies. Let's call it opportunity. But, if you have a problem, profiting from various events, whether that's the miners falling short of something, or, profiting from the fact that we have enough storage in natural gas. So therefore it goes down. You sell it, right? It doesn't always have to be negative, but it's a skill of reading supply and demand, right? So a lot of people, when I don't really tell many people what I do when I first meet them. They ask me, and I just say banking and data. That's where I end it. Because even if I start, if they're not in the industry, they won't know what I'm saying. When you start to go down the rabbit hole, that becomes a little uncomfortable, because some people are like, well, you make money off like bad events. I was like, yeah, but I also make money off good events. Like, what's your point? And they're like, are you like a really cold person? And I'm like, well, maybe. I'm not particularly emotional. Am I cold? No. I love people around me. It's not, love my dogs. Love my family, love my, closest ones. But at the same time, I don't allow too many people into my life. So maybe maybe they are right. But yeah, to me, this is just price action, opportunity. I don't have a problem with either side of things. I'm not opposed to making money when there's a deficit of something. I'm also not opposed to making money when there's a surplus of something. And I think that is our job, right? Speculators. Well, the righteous one. Silver was moving. Yeah, it was moving, and I was doing trades on it on, get this, 35 tick stop was super comfortable. Enough to bring me my 100-minute targets, which would then also 2R at 70 ticks. Right? But now, by using the same formulas that I use, the calculation is 160 ticks and 2R on that, right? So it's 340, whatever it is. That's the amount of volatility that we've expanded. So it's like, it's crazy. So I do agree, but it's gone the other way. It's gone too far the other way, too volatile. Trading nickels. I FOMO'd into a gold long because I slept in, but on my account marked great positioning. I have buys set at a deeper pullback. I set my brackets to run tighter for those so that it is a deeper low. Yeah. It never comes in. I enter early when sometimes bulls and longs beat up shorters who want a little more. But if bears take over, it'll cost me less if we get a deeper plunge where another bracket is. Yeah. Yeah. Joseph said, hey Deeyana, first time watching your live stream, great value. Thank you, Joseph. You will find that I'm quite stubborn with my levels and that sometimes I don't have a trade for this time of day. So they will be making an announcement tomorrow when the whole team comes back. And by the way, this is the last stream for today until slow markets. So there is no daytime show because the Topstep TV team in the US is off for President's Day. It is a bank holiday. So that will be it for the Topstep TV side today. However, on Wednesday, we are changing, and this is now really happening. We're changing the time slot. Hey! And initially I was going to run it from 5 a.m. Central. Well, it turns out we're going to run it from 5:30 a.m. Central, and then we're going to run it till 7 a.m. and then we're going to go straight into the opening call a few minutes later. So that was the suggestion from the team. So the new time is kicking in on Wednesday. We also have a little bit of a rebrand for you prepared, but yeah, keep your eyes peeled tomorrow. They will be announcing it tomorrow when the team is back. So exciting times. We've been waiting for this since October. Well, I've been waiting on it since September, but finally we're gonna do it. And then I can cover the LME and I can cover the pre-COMEX and pre-NYMEX stage and development, which is when I typically start looking for my setups, and I usually get about 1 or maybe 2 trades right in that kind of livening up moment before the regular trading hours begin. So it is happening finally. Now I will try to tidy up Bob in the background, because right now I have my my saxophone and my guitar, one of the Ibanez's, holding it up. But I'm actually going to make an effort to put it up on the wall for a change, rather than just leaning the neon sign. Some of you may not have even noticed, but this is like blackness in here that I'm like, it's too dark, what is happening? So I need to deal with that. And I'll try to deal with it by the new show. Yeah. Ani says, work full time, don't tell anyone that I trade, people don't understand and think you're a gambler. See, my people don't think I'm a gambler, but when I start talking about, it's like, what is it that you actually do? And I had this conversation with one of the musicians that I was traveling. We were doing, where were we going? I think it was Italy or somewhere. It was a European gig. So we're sitting on the plane, bored, whatever. And she's like, so you do like finance? And I'm like, yeah. Oh yeah, friend, like Kelly Marie told me. And I'm like, okay. Kelly Marie was a DJ girl who ran one of the bands. Never mind. And I said, yeah, I do that in my other time. And the girl really pushed. She was like, so what do you actually do? And I'm like, well, I analyze price action, and then I take in some of the levels, and there's these things called the options, and then I aggregate the data, and I use some statistics and probabilities, and then I figure out what is the best thing on the day, whether to buy it or sell it. And she's like listening. Poor girl, she really tried to understand. And then she asked me some questions. She's like, so what do you like? Do you actually like sell physical stuff? And I'm like, no, it's just price action and speculation. So there's no actual physical. I mean, technically, they are physically settled. You do, if you are a user. And I go into this D moment, right, where D just generously offers her knowledge. And after about half an hour of me trying to explain that, she's like, I mean, it all sounds really interesting, and I really want to understand, but I still have no idea what you do. So after that interaction, I was like, yeah, D, you should probably just keep your trap shut next time. So now people ask me what do you do, I just say banking. And they go, oh, like what in banking? I said data. And they're like, oh, okay. Then it ends there. So yeah. Just don't talk to people about trading. They don't get it. Nobody gets it, because there's not enough. There's a huge information asymmetry from the regular person on the street and the industries that I was traditionally a part of, where they don't get it is a probabilities game. And yes, there is a risk, but we are risk takers as long as that risk is reasonably controlled. That is what we're here for. So yeah. Yeah, exactly. So the Trading Nichols says, you're not a gambler, work hard to do quality risk management, which if you don't, or at least I don't, I'll never overall win with these markets. No one will win. Nobody gets lucky to a 20-year, 30-year, 40-year career in the markets. It's always being risk-aware, risk-mindful, and also a risk-taker in the right situation. But you can't always take risks. If you have a range-bound day and you're not Dolby and you are not good at ranges, that is not the day to be putting on risk. That is the day to size down or maybe stay out altogether. I sucked at range trading for 7 years. And then eventually I was like, I need to tackle this because I can see it, right? I can see it. It's just I suck at anticipating because I'm like, I see it's a range, it's going to break out. I had that mindset because I'm a mean reversion trader. So every time there was a range, it usually proceeded to go into like a big movement. But if it's a range on like a full profile, for example, we have a neutral day where we've had like push and pull around that first hour on both sides, but they never broke out. That's a range. Those ranges are what I like to trade. And then I'll be like able to anticipate and to prepare for my trade locations rather than going, we're going to break out. I go, no, it's probably going to fail. And then if it does for some reason break out of this, so be it, right? And then maybe I can catch the mean reversion after. But for now, we have a range. So let me identify highs and lows of the session. Let me get into the maybe second standard deviations. Plop a VWAP on there, session VWAP for the middle, which becomes your target. And then you practice. Then you practice the uncomfortable side of things, and that was uncomfortable for me. I think I stayed on the sim for like 2 months just to try and tackle my range problems. It was a long time ago now, but now the ranges are no longer a problem. Now I'm doing something completely different with the executions that are really uncomfortable for me, adding on to a winning trade. And there is a MFE that I'm using that I won't go past. And I also start with the multiples of a position. So I don't start with 1, then add 2 and 3 and 4. I'm still uncomfortable. I think that's the stupidest thing you can ever do. But starting with 4 or 5, and then adding 1, then another 1, then another 1, it won't screw up the average too much. But I'm still uncomfortable when the 3rd and 4th scaling come in. There's butterflies, So until I sort that out, I need to just keep practicing, basically. I'm all right with 1 and 2. Absolutely fine there. But yeah. Joseph says, I had a girlfriend once. She thought trading was easy. Every time I tried to focus on trade, she would get angry and stir arguments. I ended up losing 7 months of consistency prior to the relationship. Yeah, that's terrible. See, I've been married for a long time now. And we've been together for like almost 21 years, but we were married 11 years ago. Is it 11 years? Yeah, it's going to be 11 years this year. And so we're both nerds, right? So every time he walks in and I'm working, I literally just say, very busy, can you wait? And he's like, yeah, no problem. And I do the same. I bounce into his office and go, hey, blah, blah, blah. And he's like, do you mind? I'm like trying to do something. And I'm like, yeah, sure. It's never an issue with us, right? But I can understand that it can be a source of tension in a relationship. It's just that, I'm a very stubborn person. I've actually had other relationship breaking down because of my stubbornness of like being dedicated to the craft that I'm trying to achieve. And I remember when I was much younger, I broke up with someone because they were having an issue with me having like nightly gigs. And I'm like, that's my job. Like, I go to clubs with my band to make cash, right? Do you understand that, right? And he was like, yeah, but you never spend time with me. And I was like, I spend time with you once a week. That's all I can spare. Because the other 6 nights, I'm in clubs. And, and I had a problem with that. And he had a problem with that. And I was like, you know what? Goodbye. So yeah, it's a difficult one. It is. You try to dedicate your time, you try to get focused, and somebody's like, Yeah, it's easy. What do you do? Like clicking buttons. It's like, yeah, what about mental capital and the fact that you have to be not frustrated, and because the markets can frustrate you. It's a huge mental game these days, Never used to be in the pits. You could see what they're doing, but now it's just you, the computer, your emotions, and you just have to control yourself. So a lot of introspective work needs to be done. This is why we have the neuroscience lectures. This is why you should be reading about neuroscience and how your brain works and why fight or flight happens, both on the biological level and the psychological level. Where does it come from? It never comes from the recent traumas or events. Always, always, always comes from something that you experienced as a kid when you were like 3. It's endlessly fascinating to me. But, once you get to know yourself, which is difficult because, we all have negativities that we don't really necessarily want to know about ourselves. But as a trader, you have to look the truth in the eye, look yourself in the mirror as we really are, and then tackle those negativities one by one. You get frustrated, explore why you get frustrated. You get angry and break stuff, you need to stop that. You need to understand where that anger is coming from. Is it unfulfillment from something else? Or is it just, you not being, able to lose or not wanting to admit the loss and taking losses. Coach Paul says, love your losers. I absolutely love that. But love your control losers. Don't blow up an XFA and go, hey, I love it. It's like, no, that's not the name of the game. Love your controlled losers. Absolutely. But absolutely hate the ones where you go on tilt and you blow up. However, those are also opportunities to learn. Completely normal in the beginning because you don't have the emotional regulation yet. Once you get better at it, it will stop happening so frequently. Then it will happen less and less until someday you get to a point where those Muppet moments will only happen, very rarely, and usually you can get ahead of them because you recognize it, and then you will have coping tools, right? Maybe you have a pair of free weights around to get rid of the extra adrenaline that is literally just a biological response to a fight or flight response, biological chemical compound that is a result of a fight or flight. And then once you understand how it all happens, you begin to control the risk, you begin to take the risk better, and ultimately you become, I would say, a better person overall. Because back in the day, I would argue that the pits were very different because they thrived on fight or flight. But nowadays, I think the better you are at trading, the more tolerant you'll be of things around you, and your threshold for nonsense and challenges in life is going to become so much higher. So maybe spend the day doing something like that instead of clicking buttons on a bank holiday, where we may or may not get any movement. Hey, it might be great. It might be a trending move, but we don't know that, right? So it's low volume. It's weird. Half of the world is off today, and the other half is kind of still trading, but we don't have those products. So maybe just take this Monday to reflect on your journey. Maybe spend some time going over your trades, seeing whether there was something that could have been done better at the time. So just don't. This is not the day to lose your accounts. Okay, A, it's Monday. B, it's bank holiday, and C, there will be plenty of time, guys. Plenty of time. That's all I have for you today. So this will be it for Topstep TV today. The team is off, like I said. They're coming back tomorrow, but tonight we do have the slow markets with Coach Dakota. So make sure you tune in. Until then, I wish you all a happy Monday, and let's see what this week brings. I'm Mark Sukadi. This was the Euro Trade. Take care.